Hello student, Assalamu alaikum. I am Tanjia Afrin, Finance and Banking Department, Milestone College. Today my topic is Chapter 4, Class 9 and 10, Risks and Uncertainty. We know our life and the future is all full of risk and uncertainty. Always future is uncertain. In a business, risk and uncertainty going parallelly. In our country, in case of business, an investor should measure or identify risk and uncertainty both. There we can see that the risk and uncertainty creates obstacles in fulfilling goals of business organization and investors. So an investor should always measure risk. How many risks is there? How many uncertainty is there? So first, what is risk? We have to know the definition. Risk: when we expect anything and after the event the result is another one, the difference between the expectation and the actual result is called risk. This risk we can measure, we can calculate, and also sometimes we can avoid it also. Now, uncertainty. What is uncertainty? The portion that we cannot calculate or measure and can't avoid also, that is called uncertainty. So the risk is uncertain, but uncertainty not risk. We can say that the difference between the risk and uncertainty is important for you for 2 marks. That's why you have to understand the difference between the risk and uncertainty. From the discussion we can find out 3 or 4 difference. Like, what is risk? Risk is the difference between the actual and the expectation of the result. Uncertainty, the future is always uncertain in business, in our life also. Number 2, risk can be measured, uncertainty cannot be measured. Risk is calculatable, but uncertainty cannot be calculatable. Though we can measure risk or calculate it, so we can avoid risk also. Few, a little bit, not full, but uncertainty in business or in our life. Mainly in business, investor can't avoid uncertainty. Uncertainty always in inside of the business or outside of the business, in market. Example, in our country, in our investment, there is a target 1 lakh taka we have to make profit or achieve profit, but actual profit is 90,000 taka. So the difference between 1 lakh taka and the 90,000 is 10,000. This is the risk that we can measure, we can calculate, and for this sometime we take some steps to avoid the risk. But in case of uncertainty, it's called in market, maybe in this corona situation we can say that the all economy is locked down actually. So the all investor is small investor or large scale investors, they make a uncertainty. We didn't know all this, what will happen in future or next 1 month or 2 months, in each time next. There so many business is already planned, but uncertainty, this is uncertainty that is unfortunately it's happened, the corona situation. This is called the uncertainty of the business. By studying this chapter we can learn able to explain the concept of risk and uncertainty that I already discussed, identify the source of different risk and uncertainty, analyze the impact of risk and uncertainty on financial decision, because its impact on decisions more than the asserting the difference between risk-free income and risk income. Explain the financial decision making process by using standard deviation and variance. Next, there are two types of risk. The difference between risk and uncertainty already I discussed. What is risk and what is uncertainty. Now I explain how many types of risk, the source of risk. Mainly two types of risk. One from the perspective of firms and another is from the perspective of investor. First, from the perspective of firms, number one, business risk. What is business risk? To run the business successfully, a businessman have to invest or make cost daily, like salaries, wages, raw materials purchase. All these are the expenditure and the cost of a business organization. Risks may arise from the inability to meet those costs. Already I told the costs are operating cost, raw materials, wages, salaries, office rents, insurance, all these are, and sometimes variable cost also. In business firm, sometimes it needs different types of fund to go to ahead or to run the business, and sometimes business organization collect fund from internal source, and from the internal source when it collect fund, they are increase or arise a business, that also known as business risk. Business risk means all the risk is create inside of the business, maybe operating cost or maybe the internal source. Two types. So in STEM, when we question you what is business risk, you have to find out the clue that's the inside of the company or a business happened, and you have to find out that is it raw material, wages, salaries, office rent, or insurance, or other, or in other side, from where it collect fund. It may internal side or external side. When it collect fund from internal side, then the risk is rise is called business risk. This is the perspective of farm side. Another one is risk, financial risk. Financial risk is when a company collect fund from external source that's and the risk is arise is called financial risk. Financial risk is sometimes makes the company bankrupt, because loan is good for a company to reduce tax, but when it become more on the ratio basis from assets, like assets is less and liability is more, loan is become so more and big amount, then company unable to repay the all funds to the external source, and financial risk is arrive. Like a company get loan from bank, insurance company, or financial organization at 15% interest rate, and the amount is also big, like 20 crore or 50 crore, whether the assets is low and maturity period is 5 year or 7 year, then the company sometimes unable to pay the big amount, and also with interest rate 15%. That time the risk is created. This type of risk is called financial risk. Financial risk is very important for a company to measure, because a bank can be bankrupt also for the reason of financial risk. This financial risk is to find out different way, like standard deviation or variance. There you can see that the company can be bankrupt by this risk, financial risk. So when the moral sentence is, when a company collect fund from the external source and can't repay within a time, then financial risk is occurred. And this is important because if company can't measure properly the financial risks, the bank will be bankrupt also. This is all about the business risks and the financial risks. And another one is from the perspective of investor. From the perspective of investor, first one is interest rate risk. What is interest rate risk? When an investor buy bond, debenture or some other securities, then he have to face interest rate risk. The reason of that value is investor moves ups and downs sometime. The interest rate of bond in market fluctuated. When the interest rate is more, the value of the bond and debenture will be decreased, and when the value of interest rate is decreased, then the value of bond or debenture will be increased. This is called the interest rate risk. Sometimes there is some knowledgeable question, who face the interest rate risk? Now the answer is bond holder or debenture holder, because in the market there is a interest rate of bond and debenture, and when it fluctuate rapidly, then the interest rate is occurred or arise. And businessman or investor always have to understand or measure this kind of risk, and this is important for investor also. His investment become loss due to the interest rate risk. Second is liquidity risk. Liquidity, we know the near cash or cash is called liquidity, and the risk about the liquid is called liquidity risk. When investor invest in share market or bond or debenture and purchase stock, bond, debenture, shares, all these, sometimes he need to require all these investment in cash rapidly, very fast. But when he fail to cash all these equipments or instrument, then the liquidity risk is arise. Liquidity risk is very important because sometimes an investor or a businessman or a financial manager also need hard cash, but when he didn't get it, to run the business is very tough for him, because daily working capital, daily expenditure, all these are mitigated by the liquid portion or minimum liquid portion. Always investor or a financial manager have to keep hard cash in his hand to run the business and to mitigate the daily expenditures. That's why sometimes the company face liquidity risk. Sometimes the financial managers purchase all the stocks, bonds, share, debentures and fail to cash it within short time, and then the liquidity risk is occurred. So shortly we can say that the securities are converted into the cash. When it's unable to cash rapidly, then the liquidity risk is happen. This is called liquidity risk. Next, implications of risk. It means the use of risk in business. To make decision or to choose any project or to head the project, to run the business, risk is very important or significant part. A financial manager can find out the risks by different types of method, like standard deviation, covariance and variance, and so many more. Now in your textbooks only standard deviation and variance are there. We can say that to earn profit by a business organization depend on demand of its product in market, and there is so many risks: business risks, market risk, liquidity risk, financial risk, then interest rate risk, to have, or an investor have to find out or measure all this kind of risk. We can also explain that an investor or a businessman makes so many umbrella. He thought that in next rainy season there is so many rain will happen, but we can see that the rain will not happen as expected, so the business of umbrella become fall down. This is the one kind of risk in business area. Next, risk-free return and risky return. Sometimes the return is also risk-free. We can say that when risky and risk-free. Risky is when the expected earning by income are fluctuated so many rapidly, then this is called risky return or risky earning. And risk-free earning by return is when we investor or we invest in a side where the income is not fluctuated, is flatter, like when we invest in government bond, government treasury bills, then there is little bit income or no income, little bit income, and it's flatter. No fluctuation is happen here. All these are called risk-free return. So you can see that there is two types of return. One is risk-free return and another one is risky return. Last one is your math, measuring of risk and uncertainty. To measure the risk and uncertainty, we will use standard deviation. What is standard deviation? It is a statistical method by which we can find out the risk. It is the measuring unit of risk also, you can say that in one word. There is standard deviation is the measuring unit of risk. By using this method we can find out the average rate of return and the risk of any project. There is a math also, and we also can show you another math in board.